Welcome back. Over the past 18 months, Broadcom stock has climbed from $60 to over $220 per share, pushing the company's market valuation beyond $2 trillion. That's a 366% appreciation in less than 2 years. On the surface, this rally makes sense. Artificial intelligence infrastructure build-out is accelerating, data center spending is exploding, and Broadcom sits at the center of this trend as a primary supplier of custom networking and switching chips for hyperscalers like Meta, Google, and Amazon. But when we strip away the narrative and examine the actual financial mechanics, specifically the gross margin assumptions embedded in that valuation, we find a critical vulnerability that most institutional investors have not yet priced in. Let's start with the math. Broadcom's fiscal 2024 10-K filing reveals that custom chip gross margins, the segment that powers 45% of company revenue, currently run at 32 to 35%. This is the foundation upon which Wall Street has built a $2 trillion valuation, and consensus earnings estimates that projects sustain 28 to 30% margins through 2027. But Gartner's latest semiconductor demand forecasts, released in Q3 2024, paint a materially different picture. Here's what Gartner's data actually shows. Custom AI chip demand, driven primarily by hyperscalers' generative AI infrastructure needs, will indeed peak in calendar 2025 and early 2026. But, and this is the critical part, Gartner projects that by mid-2026, supply will exceed demand by 12 to 18% across the custom networking and switching segment. This supply surplus doesn't persist for a quarter or two. Gartner's baseline scenario has oversupply conditions lasting through 2027. When supply exceeds demand in semiconductor markets, margins compress hard. Historically, we've seen this pattern repeat. The 2000-2002 telecom bust, the 2008-2009 financial crisis semiconductor crash, and the 2022-2023 inventory correction all followed similar trajectories. Suppliers cut prices to clear inventory. Gross margins often fall 500 to 800 basis points in compressed cycles, meaning Broadcom's 32% margin could fall to 24 to 27% within 12 to 18 months of peak demand. Let's quantify the earnings impact. Broadcom's trailing 12-month revenue is approximately $65 billion. The custom chip segment represents roughly $29 billion of that total. If gross margins on that segment compress from 33% to 24%, a 900 basis point move, that's a loss of $6 billion in annual gross profit, or roughly $8 billion when annualized across a full fiscal year. Operating leverage magnification means that $6 billion gross margin hit translates to roughly $2 billion in operating income reduction, or approximately 28% of Broadcom's current annual operating profit. At today's P/E multiple of 32x, which is already premium to the semiconductor sector average of 18-20x, a 28% operating profit reduction implies a stock price adjustment of 40 to 45% from current levels, or a move from $220 to roughly $120, $130 per share. Now let's dig into the specific catalysts that will trigger this repricing. Wall Street doesn't reprice stocks on abstract Gartner forecasts. Repricing happens when company guidance changes, when earnings beats turn into misses, and when management commentary shifts from accelerating demand to normalizing demand. For Broadcom, there are 3 critical dates you need to circle on your calendar. First, Q1 2025 earnings, expected in late January or early February 2025. At this point, we're still in the peak demand window. Broadcom will likely guide strong Q2 2025 revenue and potentially raise full-year 2025 guidance. The market will cheer. And this is where sophisticated investors pay attention to the language. Watch for any mention of design-in cycles normalizing or customer inventory levels moderating. These are code phrases that suggest demand is peaking earlier than expected. Second, Q2 2025 earnings in May 2025. This is the inflection point. By May, Broadcom will have better visibility into Q3 and Q4 2025. If hyperscalers have indeed pulled forward demand into early 2025, then Q3 and Q4 2025 could show sequential revenue declines or flat growth, the first time in 18 months. If that guidance revision comes, expect an immediate 8 to 12% stock correction. Third, Q3 2025 earnings in August 2025. By this date, inventory data from distributors and hyperscaler capital expenditure reports will make oversupply conditions undeniable. This is when the margin compression story becomes public. That's when you'll see analyst downgrades cascade through the street. And that's when you could see the full 40 to 45% correction realized. This timeline matters enormously for tech workers holding Broadcom RSUs or index funds heavy in semiconductor exposure. If you're an engineer at Meta, Google, or Amazon, or you hold a 401k or brokerage account weighted 40 to 60% toward tech and semiconductor index funds, your portfolio is already pricing in Broadcom at $220 per share. In the base case scenario we've outlined, you're exposed to $90 to $100 of downside per share over the next 18 months. But let me address the counter-argument here. Some investors will say, AI demand is structural. It won't normalize. Custom chip margins will stay elevated because hyperscalers will keep upgrading every generation. This argument has some merit for the companies that control the architectural advantage. Nvidia and AMD, which design but don't manufacture, maintain 50+% gross margin because they control the instruction set and customers can't easily switch. But Broadcom manufactures custom switching and networking chips based on hyperscaler specifications. Once a hyperscaler's custom chip architecture is mature and stable, which happens around generation 3 to 4, the design is essentially commoditized. Competitors can enter. Customers can negotiate aggressively. TSMC 2024 earnings reports already show that advanced packaging and custom chip gross margins are normalizing faster than expected. Here's another counter. Broadcom has pricing power because it's embedded in hyperscaler critical infrastructure. True, but switching costs matter less than you'd think. Facebook/Meta, Google, and Amazon all have world-class chip design teams. They have the option to bring custom networking in-house or diversify suppliers. In fact, Meta's earnings transcripts from Q3 2024 already hint at increased internal networking chip development. As soon as customers believe margins will compress, they accelerate internal development or diversify suppliers, which accelerates the compression. Now let's talk about what happens to RSUs. If you're a tech worker with 12 months of unvested RSUs worth $150,000 in company stock, which is common at Meta, Google, or Amazon, and those companies hold Broadcom in their index fund allocations, you need to understand the correlation. When semiconductor stocks fall 40%, tech stocks generally fall 15 to 25% because the entire AI infrastructure narrative gets repriced. Your unvested RSUs could decline 25 to 35% in value during the repricing window, the exact period when you're most exposed to company-specific risk. Here's what sophisticated investors and insiders are doing right now. They're beginning to trim semiconductor overweights ahead of Q1 2025 earnings. JP Morgan's quant team published a note in December 2024 flagging semiconductor margin compression risks. They're not calling for an immediate crash, but they've reduced their semiconductor overweight from 6% above benchmark to 3%. For individual investors, the 3-week window around Q1 2025 earnings, likely mid-January through early February, represents your optimal rebalancing period. At that point, Broadcom will likely provide optimistic guidance. The stock might even spike 5 to 10%. That's your exit window. Use that strength to trim semiconductor exposure, rebalance your tech index fund overweight, and reduce concentrated RSU exposure if you hold significant amounts. Let me be specific about the numbers one more time, because this matters. Broadcom's valuation assumes 30% plus custom chip margins sustainable through 2027. Gartner data shows that assumption is at risk starting Q2 2025 and becomes untenable by Q3 2025. A 600 to 900 basis point margin compression cascades to a $5 billion operating income reduction, which at a 32x P/E ratio implies 40 to 45% downside. That downside window opens in the Q1 2025 earnings cycle and fully expresses by late Q3 2025. If you're holding this valuation risk passively through an index fund or actively through RSUs, the next 18 months represent a critical period. The repricing won't happen overnight. It will unfold across the 3 earnings cycles we've outlined. But the math is clear, the catalysts are visible, and sophisticated investors are already hedging. That's the trap. The narrative is still bullish, the stock price is still elevated, and management guidance is still optimistic. But the actual financial mechanics, margin compression driven by supply-demand imbalance, are pointing toward a 35